I can tell whatever I tell to my agent. How he behaves in front of the customer is not in my control.
I want to understand from you, how do you manage to survive and stand out from the pack?
Yeah. So Gautam, I'll give you a slightly boring answer to that.
Okay. All that is gold does not glitter. Not all those who wander are lost. The oil that is strong does not wither. Deep roots are not reached by the frost. Those words from Tolkien seem to ring true when it comes to harnessing a fortune that lies at the bottom of the income pyramid. It is an adventure that many startups have embarked upon today as India's digital lending ecosystem presents a $720 billion plus opportunity by 2030. But unless they build deep roots with this underserved segment and craft a new world of customer journeys, chances are many from this fellowship of fintechs could fall by the wayside. But there are some who have found success in bridging the two towers of digital and finance to grow as Bharat grows. Today, we bring to you the tale of one such contender. Welcome to Crafting Bharat, a startup guide powered by AWS. I'm your host / narrator, Gautam Srinivasan. Well, our knight in silicon armor started out in semiconductors and went on to found a company that provides instant consumer credit to fulfill a quest to use technology in helping people. Let's welcome to our show Krishnan Vishwanathan, founder and CEO at Kissht. Krishnan, great to have you on the show.
Thank you, Gautam. Thanks for having me here and making me a part of Crafting Bharat series.
Indeed.
Look forward to engaging with you, and
we look forward to as well, and we have a handy buzzer to take things forward. All right, let's open the gates to some cues and views on how to run a successful fintech while aiming for the greater good. It's time to begin our first segment titled The Incubator. All right, Krishnan, let's look at the start. You started Kissht with Karan in 2015 along with Sonali and Ranveer. Now this brain trust, it came with a significant background in risk. In fact, you knew risk before lending in a sense. And they'd seen the issues firsthand that big institutions face, especially in serving these underserved segments, low income segments, so to say. But considering that the payments revolution at that point in time had yet to gain full steam, based on what alternate data inputs were you looking to underwrite loans and serve them to this underserved segments?
so thanks, Gautam. You're right. We started the journey back in 2015. And just a very, very quick anecdote.
We love anecdotes.
Yeah. So my driver, who was with me for, at that time, a good 8 years, wanted to buy a house. Steady income. Of course, the income, there's no pay slip that goes to him, but reasonably steady income. And was looking for a home loan of 8 lakhs. And was a very, very big task. Ended up getting loan from me largely, right? What that triggered in me was, why is it that someone who genuinely has a stable income is still not able to get a loan which is commensurate with what he needs and what he's able to repay?
Fair point.
That was the trigger point. And when I say we, I'm talking about the founding team, when we took a step back and what if I were to be an objective analyzer of my driver Shashikant, what would I be looking at to be able to assess whether he's a good credit repaying person or not? And the answer was perhaps his habits, digital habits, where he spends his money. Perhaps if I were to find out how much electricity bill he's paying. Perhaps if I know something about his habits around media consumption. It was all at that time a hypothesis. And that hypothesis basically led us to say, are there digital alternate data? That was the time you see Jio really took off. And 3G at that time and smartphones literally was there in every hand. So information was easy to come by. How do I make sense of that information became the starting point hypothesis for us. I think what we had to overlay and just being humble, all of this data is untested. And when we talk about models, first model is always not the right model. The idea was, how do I then overlay what is essentially a hypothesis into what could be a business model solution?
What was your approach?
The approach is what we call as a low and grow approach. how do I take a low exposure on a person who otherwise I trust and say, let me give a small exposure to the person, limit my risk. And if I'm able to understand him better through the journey, let me take a big bet on him. So from that, what we started is what we call as a bite-sized loan.
All right.
And overlaying what is proxy data, not accurate data, but something that can give me a probabilistic statistical answer with a business model approach which says, why don't I give him a 15,000 loan and then figure out, can I give him 50,000 tomorrow or 1 lakh? It's been a
It's your
combination.
proprietary CIBIL score in a sense.
It is absolutely a proprietary CIBIL score. It took us many years to perfect it, but it's about creating that model, creating that operating platform behind it, and maybe at some point I'll get into it. How do I ensure that the customer remains with me for an extended period of time?
That's very
being
important.
the third big
Especially,
differentiator.
in today's time where the profitability narrative is strong versus pure growth, retention becomes a key driver for startups. And it's interesting that when you talk about this intention of the customer, right? When you're judging it with probability, I'm actually seeing it percolate down to the marketing of companies where we say, we'll give you a loan based on your niyat rather than, a host of other factors. All right. Let's look at the picture right now, right? FY23 has been a fantastic year for you, profitable to the core. So I want to understand something in the context of what Karan had mentioned in an interview, where he said that the lines are getting blurred in terms of the segments that you serve with, I think, a good 10% of your active customer base actually having, I think, 800 plus CIBIL scores, and you've got multiple credit cards, a very affluent base. So it seems like while you're trying to solve for a particular customer, you've solved actually for many other segments of customers. So what does this blurring of lines, in a sense, indicate for how you approach the business now? And do you think this was the X factor which sort of drove you to profitability?
So I would say this was one of the X factors. To narrow down our success today to one factor would not be accurate. Let me put it this way. Access to credit, which was a differentiator in 2016, is a basic commodity today. If I am a new startup today starting with access to credit as my differentiator, I'll fall by the wayside within 6 months. And therefore, the answer has to be something beyond that. For us, the answer has been evolving from a product innovation standpoint. Lending is one of the most commodity product, right? Centuries old product. A large institution today would not even afford a basic flexibility for a person to choose his own loan amount, repayment schedule, repayment flexibility. Does he want weekly, monthly? I mean, these are basic things we started on day one. The segment we started with, I'm not talking about the affluent segment you're talking about, the segment we started with are people who are irregular salaried. They are small business owners.
Self-employed, probably.
How do I create a product feature that allows for repayment flexibility within the contract itself?
Okay.
Can he postpone one payment built into the contract? Because they are people who will face hardships along the way. Those are basic features which we innovated, made us, get a trust factor with the customer going on day one. Another part of the product innovation, we started what is called as a working capital loan for small business owners. It was a discovery we did much down the line after we started the company. One of the use cases I talk about, we've taken our investor to some of these customers of our borrowers of ours. He's a large vegetable vendor. He goes to the other wholesale market in the morning, and typically his purchase is for a few thousand rupees. If I give him a line for 10,000, he will be able to purchase more if he has the confidence to sell it. This is a 3-day working capital cycle. They're perishable products. So whatever he buys, he has to pay in 3 days. Can I create a working capital product that has a repayment cycle? So these are product innovations that we had to now resort to because access was no longer the differentiator
That's
for us.
actually a fantastic case of understanding what a consumer goes through, right? Because your working capital product that you mentioned solves that pain point where you provide the working capital, say at the morning. I'm just giving an example. The day's course of business happens, accounts get settled, he pays you back your working capital loan plus whatever, and the rest is all his profit. So in a sense, he or she has not spent any of their money.
Absolutely. And that is where I think I think not only us, there are other industry players as well, but this product innovation has become the cornerstone for the successful fintech players versus the not so successful fintech players.
Fantastic. And speaking of product innovation, the use cases keep expanding, right? Because the AI ML solutions that you've used, Kissht, involve use cases around credit decisions, underwriting, fraud detection, document processing, so on and so forth. But I want to understand the challenges that you faced initially in your machine learning journey and how AWS helped you overcome them and helped you scale up.
Yeah. See, one of the interesting part of anyone who has been part of a startup journey in the last 5 years, they've all gone through the COVID phase, the pandemic phase. And a large part of our ML journey coincided with the work from home. You have scientists sitting all across India having to collaborate. So for us, the biggest part of the ML toolkit, so to say, was what is a standardized approach where I can test and train these models while enabling all our data scientists and technology people to be working remotely from anywhere. And I think, products like SageMaker Studio has really enabled us to create this very homogenized standard product our scientists can focus on model creation and not on ML ops. And I think the second part has been, it's more specifically, we have grown from being a company that disburses 1 crore loan to today we are talking about 1,500 crores of disbursement monthly basis. We are talking about 1 crore plus borrowers. The ability to scale and test the models, deploy them, it's a cost factor, it's a time to market factor. I think both of these AWS has been fantastic.
They provided you with the canvas, you made a masterpiece.
Absolutely.
All right. Now, you were among the first wave of digital lending platforms, along with the likes of, say, Early Salary, Zest Money, and Credit Bee, so to say. And you had minimal overlap with your competitors at that point in time. But when we fast forward to today, the fast-paced digital lending landscape and ecosystem that we are seeing, many have fallen by the wayside. And many are still gunning for the fortune at the bottom of the pyramid. So I want to understand from you, how do you manage to survive and stand out from the pack?
Yeah. So Gautam, I'll give you a slightly boring answer to that.
Okay.
And the boring answer...
I'm just going to see if the buzzer is working. Yeah, okay. If it's too boring, I might buzz it. All right, go ahead.
And the boring answer is, I'm a slightly grey-haired entrepreneur. I'm not your 25-year-old billionaire. And what I have learned along the way is, if your business model is building for scale and you have a very fundamentals-based approach to value creation, you will live for the long term. And what that meant for us specifically was, we have never chased growth, or at least not abnormal growth.
Okay.
In lending, they always say balancing growth versus risk. It was never a question or a balancing. It was always a risk first for us, right? When you put risk first and you put customer first, I think the solutions start appearing in front of you. What the drawback for some of these things are, we've probably grown slower than some of our peers. I know a couple of organizations started after us. Technically, on paper valuation, they're ahead of us. It doesn't bother us because we know we are here for the long term. We are here to create an institution like Infosys and TCS. That's what we are here for, right? Something that will outlive us. And I think that approach, which is unit economics based, fundamentals, not chasing undue growth, keeping customer first, has really helped us.
All right. More power to the gray hair and old school thinking. All right. Now, when we talk about lending, sure, the headlines are always how much you disperse. But we come to the meat of the conversation, the ugly side of lending, which is recovery. Because your customer, say, is having a hard time but he still needs to pay back, he or she. So how do you manage to have a good reputation but still maintain the bottom line? So this recovery aspect, how do you address this challenge?
Yeah. No, it is unfortunately an ugly side, but at an industry level, we don't personally see it that way. If I talk about Ring, the traditional challenge has been 3 parts. One has been that there is no control on the frontline interaction. I can tell whatever I tell to my agent, how he behaves in front of the customer is not in my control. The second challenge has been, it is not a dialogue. They're discrete conversation. You go and talk to the customer today, you go talk to him after a month, after a few weeks. There's no dialogue happening. There are discrete conversations. And I think the third part is, it's a very cookie cutter approach without any analytics or insight into the conversation. And I think we solved all 3. On day 1, we implemented what we call as an automated collection workflow. Nothing great, Toyota workflow system that just manages things and processes and everything. It doesn't look great, but what it helped us do, the right set of information that is required to have a meaningful dialogue was placed in front of the agent when he has that conversation. And all of these conversations are digitized and kept handy for every further conversation. So in a way, we transform discrete conversations into dialogue with the customer. That's point number one.
Is this where you're seeing Gen AI playing a more important role?
Absolutely, absolutely. And I'll come to that as well. I think the second part we did was controls. All of our callings are recorded. We do massive audit. It's a cost. We are willing to bear that cost. We do something which is very unique in the industry, which no one else does. All of our field call agents have to carry our app so that we are able to record the interaction. So that just gives us control, and we are able to, if tomorrow the customer has a point of view and the agent has a point of view, we are able
It's like
to
an overall CRM platform where all data is logged.
Absolutely. And last, there is analytics there. They may not be the most advanced machine learning out there, but who's my customer who's a self-care customer? As in, okay, the due date is 5th. I know historically data tells me his income cycle lands on 10. I just wait 5 days, he will pay back. I don't have to annoy him for 5 days.
That's where the flexibility helps.
That's the flexibility and analytics saying I need to know what my customer is capable. Is he genuinely in stress, or is it just a timeliness of payment issue, right? I think those are three things which require technology and data to be implemented. We invested in that. So we didn't invest just in the front end underwriting and risk. We invested in collections as well, and it has helped us. Lastly, I know it's a long answer. For us, in any organization, financial services, collections efficiency, as in amount of payment you collect, is the incentive driver. For us, zero escalation is the incentive driver. If I have zero escalation, you may be the most efficient agent. You will not get an incentive. In fact, you might end up losing your job.
Your answer was so good, I'm not going to press the buzzer to interrupt you, but I'm going to just press it for my sake. But I love the fact that when you talk about investing in connections, you're looking at the human experience. As you said, technology is powering your agility to take decisions like if the customer is not able to pay today, maybe 5 days later, we give him another chance. And zero escalation, as you mentioned, that's the driver that you're looking at. Fantastic. And now, I made a Tolkien reference at the start. So we are going to talk now about the power of the ring, especially your evolution that has come about. Now with Ring, that's a simplified product which is combining payments and credit, and your focus is to go after millennials, the underserved segment there. Now, I read that the opportunity is close to 150 million people and the penetration as low as 5%. Perfect opportunity. So in this context, tell more about Ring and how you're leveraging Gen AI to help you with this big opportunity and the next level use cases that you're seeing with Gen AI for Ring.
Yeah. So see, when we started the journey, we were largely a lending company. When we introduced our working capital product, suddenly we realized it's being used as a payment solution. So Ring is a culmination of saying, how do I blend payments and lending into one platform which is very seamless to the customer? So we are introducing feature. We have a TPAP license from NPCI, so building in UPI payments into it. The idea being, I want to make sure that we are a one-stop solution to the customer, and he doesn't ever have to go beyond us. When it comes to Gen AI, now as I introduce new products, what becomes relevant is, am I a clutter or am I a seamless solution providing everything that the customer asks for? And that's where Gen AI really makes a difference. See, Gen AI is a very, very wide canvas. I'm not an expert. I'll tell you where we are focusing on Gen AI today in the company. We are today focusing on two things. One is mass customization and improving interaction with the customer. These are two topics on Gen AI where I genuinely feel today there's a here and now.
That's hyper-personalization at scale.
Hyper-personalization at scale, right? Which is basically, how is it a menu-driven product? On the interaction front, can I automate, can I build in my systems and automate all of my interactions with the customer? It's not so much as to save cost. It is to make it easier and faster for the customer to get served. So Gen AI being used to automate a lot of the service requests, also using voice analytics. Again, I'll keep coming back. Lending is ultimately a product that does cause hardships for the set of people who don't. How do I use Gen AI from voice analytics perspective to understand and empathize with the customer and take timely actions? So these are, so on mass customization and on interaction with the customer, we are thinking of Gen AI as being the next
frontier to conquer. But as you said earlier, invest in connections and you unleash the true power of the Ring to take your last answer. All right, that's your 15-minute quest on giving credit where it's due to drive financial inclusion based on the true story of Kissht and Ring that's evolving. How about we take a quick detour for some side quests on understanding everything from regulation to innovation. Let's begin our next segment titled the accelerator. All right. Krishnan, let's look at the slice of life a bit more rapidly. What's your view on the regulatory landscape evolving, especially when it comes to balancing growth and risk, and when it comes to separating the good players from the bad?
Last 18 months has been a regulatory roller coaster. And the only reason it has been that, I genuinely feel that the market players took the shortcut on regulations, took the shortcut on some of the gray areas of regulation. And I think what that has led to, all of us have had to adjust our lives. But what it has also allowed us to do, what was gray 18 months back is black and white today. You may agree or disagree, but it's black and white. You know what you have to do and you know what you can't do. And that has given us a sense of clarity on the way forward. For the first time since the digital lending guidelines came out, and then there have been subsequent 2 or 3 around other aspects of operations of digital lending, we have become a standardized sub-industry. It is a recognized industry now. And that has given us the ability to scale. That has given the investors the confidence that there is no more shocks waiting. But if I were to take a step back, I think there's a big learning for us as an industry and for other nascent industries that might come up. Regulations are there, it's a given. Look at the spirit of the regulation and not just the letter.
We have parents for a reason, right? They help us guide, and of course, through this guidance, you've avoided the mountain of doom which would come if it was unregulated. All right, next, highlights of your funding journey.
Two big highlights. One big highlight, all of our early stage investors continue to remain with us. In fact, invested till the last round. Big testament to the fact that they believe in us, in our business model and our team. I think the second big highlight has been that, we have always chosen investors not for the capital, but something more they bring, whether it's market connect, whether it's international peer exposure that they give to us. And that has really helped us remain. And largely, we've chosen investors who share the long-term vision like we do. It makes a big difference.
Be in it for the long drive. All right. If existing lending products are viewed as digitized versions of their analog experiences, right? What's going to be the second layer of innovation which truly drives the digital experience of lending forward?
I think, sorry for belaboring the point, it has to be menu-driven mass customization. It has to be something that fits. There is a customization of one. It has happened in other industries. People generally feel it's not something that will work in financial services, but it has to be the way forward. I think the needs of specific customers are very, very different. Oftentimes, technology comes in the way of offering that product. I may have the intent. If I give me an Excel sheet, I know what you want, Gautam. I will create the appropriate loan product for you. But how do I make my Ring platform, make it available seamlessly to you in front of you, is going to be the next level of innovation.
The antithesis to that point, as you mentioned, some technology can sometimes come in the way. But what is your guiding mantra for using technology to solve the problems of today and tomorrow?
I have a guiding mantra for technologists, not for technology. Have empathy in your product. Have empathy in your product, and and build for scale, something that solves a real problem. Wowness in technology does not necessarily mean solving a real problem. So if you solve a real problem at scale with empathy built in, I think that's the mantra I would say.
Absolutely. And finally, what's the message that you want to project to all the startup founders who are listening into the conversation? That summarizes the whole discussion that we've had.
Be ready for ups and downs. It takes a toll. Be ready for ups and downs. Build a strong, capable team. You will need it when the chips are down, and have a balanced life.
Be ready for your journey, young Frodos and Bilbos, and let's see where your epic adventure takes you. That's your bird's eye view of navigating the fintech startup life right here on Crafting Bharat, a startup guide with Krishnan Vishwanathan of Kissht. Let's deal now with a mini quest as we get Krishnan to answer some questions sent by our enterprising audience. And he's ready. We are ready. Here's our final segment titled The Advisor. Right, Krishnan, our first question comes from Karan Verma from FARD Network, and he asks, can you share any initiatives or programs that Kissht has launched to support small businesses or startups? You mentioned one example. Any other broader examples?
I think the thing that we are most proud of is we are the founding member of FACE. It's FACE is an industry organization. It's a it's a fintech association of consumer empowerment. I think through this platform, we've been able to do two things. One, genuinely guide regulations to enable startups to flourish within digital lending while ensuring that customer interest is taken care. And also a platform where a lot of the younger fintechs are able to come, pose their concerns with us, and we are able to take it up. So I think this our journey with as a founding member and then growing FACE into such a large organization is something we're very proud.
All right, you have the Gandalf in place to guide you ahead. All right, our second question comes from Sharan Agarwal, an angel investor and VC fund advisor, and he asks, at what stage of the business do you feel debt financing would be a better option than raising more equity? Or if you were to answer this in terms of, say, not diluting more stake in your business, then what percentage would you look at venture debt?
So there's no one answer, but let me say diluting stake is not a consideration. I think whether you take equity or debt is more a function of where your business is at that point in time. If you have confidence in your cash flow over a certain period of time, then take debt. It is, of course, cheaper than equity, but you have to have that confidence and financial discipline to do that. It should not be because you're trying to dilute or not dilute your equity. That cannot be the right reason to take it. I mean, it is expensive.
All right. The insights keep coming in. Our third question comes from Hiren Shah, founder, Vertos Advertising Limited, an angel investor. And he asks, how do you approach building a strong core team for your startup?
Empower and delegate. You're not a Superman. Right? It's okay for people to make mistakes, but it's important to have a large, capable team. That's number one. I think number two, have a common vision you can align to. Right? If you don't have it in your top team, I think it's going to be a struggle. Right? So these are the two things that are very important.
Empower and delegate. Have the army of souls by your side. Well, unfortunately, with that, it's time to call cut on this epic conversation of Crafting Bharat, a startup guide powered by AWS. This podcast is an initiative by NewsReach. Krishnan, thank you so much for sharing your journey as a founder and leader at Kissht. And I look forward to seeing the next level of digital lending solutions, making the world of finance a better place.
Thank you, Gautam, and thanks to Crafting Bharat.
Fantastic. And a big thank you to our viewers for joining us. Do like, share and subscribe to our channel for powering up your startup abilities. Till next time though, this is your host Gautam Srinivasan signing off. Crafting Bharat, a startup guide powered by AWS, is an initiative of NewsReach in association with VC Circle, produced by HT Smartcast. The director and executive producer of this show is Deepthi Ahuja. The assistant producer is Veda Mohan. The video editor on this show is Kuljit Singh. And the audio editor is Amrinder Singh.